Great. Thank you everybody for joining us as we work out the technical difficulties here of our first in our webinar series that we started this year. So we will have one at the first Wednesday of every month, and we will tell you at the end what the topic is for next month, but we'll let you wait in anticipation. So for this series, we are going to be mostly with us, the financial advisors here at Personal Wealth Strategies, myself and David Balin. But we will also bring in experts from other on other topics as well, so that we can get you well-rounded advice and lessons. So this we're going to be focusing on is the 10 investment lessons that we learned in 2021. And every year markets provide us with lessons on prudent investment strategy, and with great frequency, they offer remedial courses covering lessons that were taught in previous years. And so that's why one of our favorite sayings is from Sir John Templeton: the four most dangerous words in investing are, "It's different this time." So we'll take a look at these 10 lessons and kind of go through each of them today. And so for the first lesson, I'll throw it over to David Balin.
All right, thank you, Justin. We entered 2021 with the U.S. equity valuations at very high levels. In particular, the metric known as the Shiller Cape 10 was about 34, well above its historical average of about 17. Now, for those who are not familiar with the Shiller Cape 10 index, it compares current stock prices with the earnings history from the past 10 years. When the index has been about 34, which has happened just one other time, which is in the late 1990s, that was followed by a severe bear market. That led many forecasters to predict returns going into 2021. For example, legendary investor Jeremy Grantham, who's now the chief investment officer at GMO, predicted that 2021 would see a stock market crash. Grantham said, "When the decline comes, it will perhaps be bigger and better than anything previously in the US history." Investors who listened to that advice sold their equities and missed out on the market's strong performance. In 2021, the S&P 500 returned 29%. In his 2012 study, Cliff Asness showed why one should not use the Cape 10 to try to time the market. He found that when it was above 25.1, the real return over the following 10 years averaged just 0.5%, and 6.3 percentage points below the US market's long-term real return. This concerned many investors, possibly leading them to reduce or even eliminate their equity holdings. However, there was still a wide dispersion of outcomes. The best 10-year forward real return was 6.3%, just half a percentage point below the historic average, while the worst was minus 6.1%. Many investors may not have been aware that when using traditional price to earnings ratios, history shows there is virtually no correlation between the market's PE and how the market performs over the subsequent year. The following is a good reminder of that. On January 1, 1997, the Cape 10 was at 28.3. The highly regarded chairman of the board of the Federal Reserve, Alan Greenspan, gave a talk in which he famously declared that the US stock market was irrationally exuberant. That speech, given in Tokyo, caused the Japanese market to drop about 3%, and markets around the globe shortly followed. Over the 3 years of 1997 to 1999 that followed that comment, the S&P 500 index returned a compound rate of return of 27.6% per year. With higher valuations, while higher valuations do forecast lower future expected returns, that doesn't mean one can use the information to time markets. And you should try not to do so, as the evidence shows such efforts are likely to fail. This doesn't mean that the information has no value. Rather, you should use valuations to provide estimates of returns so you can determine how much equity risk you need to take in your portfolio to have a good chance of achieving your financial goals. However, expected returns should only be treated as the mean of a potentially wide dispersion of outcomes. Your plan should address any of these outcomes, good or bad. Our next lesson is that active management is a loser's game.
Thanks. And despite overwhelming academic research demonstrating that passive investing is more likely to allow you to achieve your most important financial goals, the majority of individual investors are still in active funds, expecting some type of outperformance. But last year was another in which the large majority of these active funds underperformed the markets as a whole. Just looking at Vanguard's S&P 500 index fund, the ETF ticker symbol VOO, it outperformed 76% of active funds in that Morningstar US large company category, returning 28.8%. Yet, like in all years, 2021 provided a great opportunity for active managers to generate alpha and outperform, since there was such a large dispersion in returns of companies within the S&P 500 and the difference between the best performing companies and the worst performing stocks. So for example, the top 10 stocks within the S&P 500 index were up at least 118%. So looking at the table on this slide, to outperform, all an active manager had to do was pick these companies and overweight these big winners, which outperformed the index by at least 89 percentage points. But on the other hand, as you'll see in the next slide, 10 stocks lost at least 22%, with the worst performer losing, almost 41%. And so on this slide here, you see those losers. So on the other hand, to outperform, an active manager would just have to underweight these stocks, or let alone avoid them, each of which underperformed the S&P 500 by at least 50%. So this wide dispersion of returns is typical. And yet, despite the opportunity year after year in aggregate, active managers persistently fail to outperform. And just in case you thought we were focusing only on US large companies, it can be seen in small stocks as well, small company stocks as well. So for example, the iShares Core S&P Small Cap ETF, ticker symbol IJR, outperformed 66% of active small cap managers, returning 26.6% for the year. So the results make it clear that active management is a strategy that can be said to be fraught with opportunity. Year after year, active managers come up with excuses to explain why they failed, and then argue why next year should be different. But of course, it never is. And so we'll move on to our third lesson now, making the mistake of recency.
So lesson number 3, don't make the mistake of recency. Last year's winners are just as likely to be this year's dogs. The historical evidence demonstrates that individual investors are performance chasers. They buy yesterday's winners after that great performance, and they sell yesterday's losers after the loss has already been incurred. This causes investors to buy high and sell low. Not exactly a recipe for investment success. This behavior explains the findings from studies that show investors can actually underperform the very mutual funds in which they invest. For example, in a 2005 study, Morningstar found that in all 17 fund categories that they examined, the returns earned by investors were below the returns of the funds themselves. Unfortunately, a good return in one year doesn't predict a good return the next year. In fact, the opposite is true. Great returns lower future expected returns, and below average returns raise future expected returns. Now, the poster child for this recency mistake could be the Cathie Wood's ARK Innovation Fund. This fund's inception was November 2014. The fund performed poorly in its first 2 years, ranking in Morningstar's 75th percentile in 2015 and 98th percentile in 2016. At that point, the fund had only 200 million of assets under management. The fund performed well in 2017, earning a first percentile ranking with an 87.3% gain. And again in 2018, earning a 17th percentile ranking. In 2019, ARK's performance reverted as it underperformed, earning a 57% ranking, even though it did return 25.6% for the year. From inception through 2019, ARK had earned 20.6% per annum versus 11.8% for Vanguard's S&P 500 index. That type of performance attracts investors who believe past performance of active managers is a predictor of future performance, and assets under management grew to about 1.9 billion. ARK turned into a spectacular performance in 2020, earning a first percentile ranking, returning a whopping 153%. Assets under management grew to about $21.5 billion. Cash continued to flood in during the early 2021, and by February 12th, the fund was up about 25% for the young year. Assets under management reached a peak of about $28 billion that month. Unfortunately for the investors, the fund lost 23.6% for the full year, earning a 100th percentile ranking. And investors who continued to pour money into the fund in early 2021 did much worse, as the fund lost about 37% from its peak on that February 12th date. Assets under management had fallen to about $16 billion at year's end, falling by more than the losses alone could explain, as some investors abandoned ship. In other words, the strongest performance came when assets were just a small fraction of what they were when the fund had its worst performance. As is often the case, the mistake of recency often leads to investors' returns being below the reported returns of the fund in which they invest. The following table compares the returns of various asset classes in 2020 and 2021. As you can see, sometimes the winners and losers repeat, but other times they change places. For example, the worst performer in 2020, US REITs, or Real Estate Investment Trust, was by far the best performer in 2021, returning 45.9%, outperforming the second place finisher, S&P 500, by 17.2 percentage points. And the best performer in 2020, US small company stocks, or US small caps, fell from first to sixth place. And the third best performer, emerging markets, fell all the way to 11th place. While the second worst performer in 2020, commodities, improved from 10th place all the way up to 4th place. Our fourth lesson is that gold is not an inflation hedge over your investment horizon.
Yep. So looking at lesson 4, looking at gold specifically as an inflation hedge, gold ended 2020 at about $1,894 per ounce. And with many investors concerned about inflationary risks caused by a combination of several things, including stimulative fiscal policy, very loose monetary policy, they may have looked towards gold as a potential hedge against that inflation risk. Another factor that may have influenced investors' interest in gold is the recency of the outperformance, creating that recency bias that we were just talking about. So in just September 2018, it was trading at about $1,300 an ounce. So while the inflation risk was realized with the consumer price index increasing about 7%, gold disappointed and ended last year at $1,825 an ounce, which is down about 3.6%. So underperforming inflation by almost 11%. So is gold really a good hedge against inflation is the question. And the following example may help provide some clarity on that. Looking in back to January of 1980, the price of gold reached a peak at that point of a record high $850 an ounce. On March 19th of 2002, gold was trading at $293 an ounce, well below where it was 22 years earlier. And note that inflation from that period of 1980 through 2001 was 3.9% per year. Thus, gold's loss in real purchasing power was about 85%. So how can gold be an inflation hedge when over the course of 22 years, it loses 85% in real terms? That being said, gold has been a good hedge of inflation over the very, very long run, such as a century. But unfortunately, that's much longer of an investment horizon than most investors have. Authors of a 2015 study called The Golden Constant, Claude Erb and Campbell Harvey, they examined this historical evidence on gold as an inflation hedge and concluded in the research, while gold might protect against inflation in the very long run, 10 years is not the long run. In the shorter run, gold is a volatile investment, which is capable and likely to overshoot or undershoot any notion of fair value. That takes us to our fifth lesson, which is that the world isn't flat and diversification of risky assets is as important as ever.
Financial crisis of 2008 caused the correlations of all risky assets to rise towards 1. Now, a correlation of 1 shows that two assets move in perfect step with each other. This led many in the financial media to report on the death of diversification. This theme has been heard repeatedly since 2008. Yet diversification benefits come not just from correlation, but from the dispersion of returns as well. And a wide dispersion of returns in almost every year since 2000 demonstrates there are still large diversification benefits. Since 2000, there were only 3 years of the 21 when the difference in returns between the S&P 500 index and the MSCI EFE index was less than 5 percentage points. For those unfamiliar, the MSCI EFE index stands for the Morgan Stanley Capital International Europe, Australasia, and Far East Index, and measures the equity performance of developed country stock markets outside of the US and Canada. In other words, it's a proxy for international investments. On the other hand, there were 14 years when it was at least 8 percentage points. There were also only 3 years when the return on the S&P 500 index was within 10 percentage points of the return on the MSCI Emerging Markets Index. There were 8 years when it was at least 20 percentage points, and 4 when it was at least 30 percentage points. The largest gap occurred in 2019 when the spread was more than 53 percentage points. The data presents powerful evidence that the investment world is far from flat and that there are still significant benefits in international diversification. Our sixth lesson is that hedge funds are not investment vehicles, they are compensation schemes.
Yeah, and this one has been appearing as regularly as active management being a loser's game. Hedge funds actually entered 2021 coming off their 12th straight year of trailing US stocks as measured by the S&P 500. So in 2021, though, looking at the Global Hedge Investable Fund Index, it produced a total return of 3.7%, which underperformed all major equity asset classes except for the emerging markets, though it would outperform the 2 bond indexes. But we can take our analysis a step further and determine how hedge funds performed against a globally diversified portfolio, rather than just comparing them against each asset class. So an all equity portfolio allocated 50% internationally, 50% domestically, equal weighted among the indexes from those tables, would have returned 19.3%, which would outperform the hedge fund index by 15.6 percentage points. Another comparison that we can make is a typical balanced portfolio looking at 60% equities and 40% fixed income, or those bonds. Using the same weighting methodology, the portfolio would have returned 10.6%, and using 5-year treasuries outperforming the hedge fund index by 6.9 percentage points, and 9.4% using long-term treasuries, outperforming the hedge fund index by 5.7 percentage points. Given the results and the wide dispersion of returns between US and international equities, one might think that hedge funds would have used their freedom to move across those asset classes which they tout as the big advantage. But it turns out that the problem is that the efficiency of the markets, as well as the cost of the effort, can turn that supposed advantage into a handicap. Let's look at the longer term evidence, though, rather than just over 2021. Looking over the last 20 years, the hedge fund index underperformed every major equity asset class, even underperforming 5-year treasuries by 1.7 percentage points and 20-year treasuries by 4.8 percentage points. The evidence demonstrates that the market has been persistently teaching investors that, on average, the only objective hedge funds have achieved is transferring assets from investors to those fund sponsors. Given the long-term evidence, it's puzzling why hedge funds still manage about $4 trillion in assets. We'll now turn to lesson 7, looking at the correlation returns of stocks and bonds. Is time varying?
From 1926 through 2021, the monthly correlation of the S&P 500 index to long-term treasury bonds has been close to 0. A 0 correlation means that when stock returns are higher than their historical average, bond returns are just as likely to be higher or lower than their historical average. Thus, it has been basically a coin toss whether long-term treasury bonds will provide higher, returns than their historical average when the S&P 500 does so. And correlations are time varying. In 2021, when the S&P 500 returned 28.8%, long-term treasuries lost 5%. On the other hand, in 2008, the S&P 500 lost 37%, while long-term treasury bonds returned almost 26%. Investors should also be aware that they can both produce negative returns at the same time. There have been 5 years when both the S&P 500 index and long-term treasury bonds produced negative returns. The worst of those years was in 1969, when the S&P 500 lost 8.5% and long-term treasury bonds lost 5.1%. There have now been 21 years when the S&P 500 produced a positive return and long-term bonds produced negative returns. And finally, there have been 18 years when the S&P 500 produced negative returns and long-term bonds produced positive returns. The lesson is that correlations are time varying, and given the historically high valuations of stock and the historically low levels of interest rates, investors should not lose sight of the fact that there have been times when longer-term bonds have not provided shelter from declining equity values. Our eighth lesson is that you should not let your political views influence your investment decisions.
Yep, and this has been a big one. And one of our more important roles as financial advisors involves helping prevent investors from committing one of the greatest mistakes, which is panic selling resulting from fear, whatever its source. The lesson to ignore your political views when making investment decision is one that rears its head after every presidential election and even midterm elections as well. But the election of 2020 was no exception. We often make mistakes because we are unaware that our decisions are being influenced by our beliefs and biases. The first step to eliminating or at least minimizing such mistakes is to become aware of how our choices are impacted by our views and how those views can influence outcomes. So the authors of a 2012 study called The Political Climate, Optimism, and Investment Decisions showed that people's optimisms towards both the financial markets and the economy is dynamically influenced by their political affiliation and the existing political climate. So among the findings were that individuals become more optimistic and perceive the markets to be less risky and more undervalued when their preferred party is in power. This leads them to take on more risk, overweighting riskier stocks. They also trade less frequently, and that's a good thing, as the evidence demonstrates that the more individuals trade, the worse they tend to do. On the other hand, when the opposite party is in power, individuals' perceived uncertainty levels increase, and investors exhibit stronger behavioral biases, leading to poor investment decisions. Now, imagine the nervous investor, and we've had discussions with several of them, all of whom were Republicans over this last election, who reduced their allocation to equities, or wanted to, and some wanted to get out of the markets entirely, based on the views that the Biden presidency and Democratic control of the House of Representatives, along with Vice President Harris' ability to break the tie in the Senate. So while investors who stayed disciplined benefited from the market's strong performance, those who panicked and wanted to get out not only missed that strong performance, but they have persistently faced the incredibly difficult task of figuring out when it would once again be safe to get back in the market and invest again. And similarly, I know many investors with Democratic leanings who were underinvested once President Trump was elected. So this isn't a one-sided issue. In December 2016, there was a survey of affluent investors looking at their confidence and evidence on how political biases can impact investment decisions. So prior to the 2016 election, with a victory for Hillary Clinton expected, those identified as Democrats showed higher confidence than those who identified as Republicans or independents. And this completely flipped after the election, whereas those identified as Democrats registered a confidence reading of -10, while Republicans and independents showed confidence levels of +9 and +15, respectively. So if you lose confidence and sell, there's never a green flag that will tell you when it's safe to get back in. And thus, the strategy most likely to allow you to achieve your goals is to have a plan that anticipates there will be problems, there will be volatility, and you don't want to take more risk than you have the ability to, willingness to, or the need to assume. And additionally, don't pay attention to the news. If doing so will cause your political beliefs to influence your investment decisions. Moving on to our ninth lesson now, it's that diversification is always working. Sometimes you like the results, and sometimes you don't.
Everyone is familiar with the benefits of diversification. It's been called the only free lunch in investing because, done properly, diversification reduces risk without reducing expected returns. However, once you diversify beyond a popular index such as the S&P 500, you must accept that the fact almost certainly will be that you'll be faced with periods, even long ones, when a popular benchmark index reported by the media on a daily basis outperformed your more diversified portfolio. The noise of the media will then test your ability to adhere to your strategy. Of course, no one ever complains when their diversified portfolio experiences positive tracking variance and outperforms the popular benchmark. The only time you hear complaints is when it experiences negative tracking variance and underperforms it. 2021 was just such a year. Although US REITs outperformed, international stocks underperformed by wide margins, and emerging markets returns were negative, leading to negative tracking variance. Successful investing requires discipline and the patience needed to avoid allowing such periods to lead to the abandonment of your long-term plans. That brings us to our 10th and last lesson. The strategy to sell in May and go away is a myth.
Yep, and this is one of the more persistent investment myths, that the winning strategy is somehow to sell stocks in May and then wait until November to buy back into the market. But let's take a look at some of the historical evidence for this. And so it's kind of the source of the myth, looking back to since 1926. It is true that stocks have provided greater returns from November through April than they have from May through October. So that could be a potential source of the myth, since 1926, the average premium of the S&P 500 index over 1 month Treasury bills was 8.8 percentage points per year. And the average premium of the portfolio from November through April was 5.9%, compared to just 2.6% from May through October. In other words, the equity risk premium from November through April has been more than twice the premium from May through October. And furthermore, the premium was negative more frequently for the May through October portfolio, with 33% of the 6-month periods having a negative result, compared to 27% of the 6-month segments for November through April portfolio. But from November 1926 through October 2021, the S&P 500 index returned 10.5% per year. However, a strategy that invested in the S&P 500 index from November through April, and then invested in riskless 1-month Treasury bills from May through October, kind of following the myth, would have returned 8.5% per year over this period, underperforming the S&P 500 by 2 percentage points per year. And that's even before considering any transaction costs, let alone the impact of taxes, since you'd be converting what would otherwise be long-term capital gains into short-term capital gains, which are taxed at ordinary income rates. So looking back at 2021, let's see how this strategy would have worked out. The S&P 500 index returned 10.9% from May through October, outperforming riskless 1-month Treasury bills, which returned 0% by 10.9 percentage points. So what's perhaps most interesting is that last year, the sell in May portfolio outperformed the consistently invested portfolio. That the last time it did was in 2011. Yet you can be sure that come this May, the financial pundits and on the media will be raising the myth once again. But a basic tenet of finance is that there's a positive relationship between risk and expected return. And to believe that stocks should produce lower returns than Treasury bills from May through October, you'd also have to believe that stocks are less risky during that time period, which is a nonsensical argument. Unfortunately, as with many myths, this one seems hard to knock off.
So in conclusion, even smart people make mistakes. What differentiates them from less successful investors is that they don't repeat them, expecting different outcomes. 2022 will surely offer us more lessons, many of which will be remedial courses. The market will provide opportunities to make investment mistakes, but you can avoid making errors by knowing your financial history and having a well thought out plan. Our greatest hope is that you have learned that the key to successful investing is to get the plan right in the first place and then to stick to it. That means imitating the lowly postage stamp, which does one thing but does it well. It sticks to its envelope until it reaches its destination. Your job is to stick to your well-developed plan until you reach your financial goals. If you don't have a plan, make an appointment to write one immediately. You can do so by visiting our website at www.personalwealthstrategies.com or by calling our office. Now, if you wish to have a replay of today's presentation, please visit the Personal Wealth Strategies channel on YouTube. We'll be sending you an email once the video is posted. And while you are there, feel free to subscribe to Personal Wealth Strategies YouTube channel so that you'll be kept up to date whenever new content is posted. You also want to be sure to mark your calendars now for next month's webinar, which will be on April 6th. Again, these webinars are going to be held the first Wednesday of every month. But our next webinar, Justin will be featured in a discussion about student loan planning in anticipation of the restart of federal loan payments and interest. If you or anyone you love has outstanding student loan debt, this is a must to attend. We thank you for your attendance today, and we look forward to seeing you again in April.